Scalping is a popular trading style. It focuses on making many small profits. These profits add up to a large amount over time. Think of it like collecting tiny grains of sand to build a big castle. Scalpers are not looking for huge price moves. They are happy with very small gains. They enter and exit trades very quickly. Sometimes a trade lasts only for a few seconds or minutes. The main goal is to repeat this process many times throughout the day. This style requires a lot of focus and a good understanding of market movements. It is a high-frequency way of engaging with the financial markets. To make money, scalpers look for tiny changes in an asset's price. For example, a stock might move from $10 to $10.01. A scalper aims to buy at the lower price and sell at the higher one. This single trade might only make 1 cent of profit per share. But scalpers trade with large volumes. If they trade 10,000 shares, that 1 cent move becomes a $100 profit. They repeat this action over and over. The key is to find these small, predictable price fluctuations. They use charts and indicators to spot these opportunities, hoping to capture small but frequent wins. The strategy relies heavily on liquidity and volatility. A liquid market means you can buy and sell large quantities without affecting the price too much. This is very important for getting in and out of trades easily. Volatility provides the price movements that scalpers need to make a profit. Without any movement, there are no opportunities to be found. Therefore, scalpers often trade during the busiest market hours. This is when the most people are trading, creating the perfect environment for their strategy. They look for assets like major currency pairs or popular stocks that have a lot of trading activity. Discipline is the most important quality for a scalper. Since profits are small, a single large loss can wipe out many wins. Scalpers must have a strict plan. They must know exactly when to enter a trade and, more importantly, when to exit. This includes setting tight stop losses to manage risk. A stop loss is an order to automatically sell an asset if it drops to a certain price. This prevents big losses. Emotions like greed or fear can be very damaging. A successful scalper follows their rules without hesitation, making consistent and logical decisions throughout the trading day. In the world of scalping, speed is everything. The opportunities that scalpers look for disappear in the blink of an eye. A price might move in your favor for only a few seconds before it reverses. If you are too slow to react, you will miss the chance to make a profit. Or worse, you could end up with a loss. Every millisecond counts. This is why scalpers need a fast internet connection and a powerful computer. They also need direct access to the market through a good broker. This ensures their orders are executed as quickly as possible, without any delays that could cost them money. Making decisions quickly is just as important as having fast technology. A scalper must analyze market information and act on it almost instantly. There is no time for long deliberation or second guessing. You see a pattern, you confirm it with your indicators, and you place the trade. This requires a lot of practice and experience. You need to train your mind to recognize these patterns quickly and trust your judgment. Hesitation is the enemy of a scalper. By the time you finish thinking about a trade, the opportunity has likely already passed. This mental quickness is a skill that separates successful scalpers from the rest. Precision is the other side of the coin. Your entries and exits must be exact. A small mistake in placing your order can turn a winning trade into a losing one. For example, if you want to buy at $10 but your order gets filled at $10.01, you have already lost your potential profit margin. This is known as slippage. Scalpers must be very precise with their limit orders, which allow them to set the exact price they want to buy or sell at. They also need to be precise with their risk management. Setting a stop loss just a few cents away from the entry price requires careful calculation and execution. The combination of speed and precision creates a very demanding trading environment. It is mentally and emotionally draining. A scalper might make hundreds of trades in a single day. Each trade requires the same high level of focus and quick thinking. This is why many human traders find it difficult to scalp successfully over the long term. The constant pressure can lead to fatigue and mistakes. The human brain, as powerful as it is, has its limits when it comes to processing information and reacting at such high speeds. This is where technology, and specifically artificial intelligence, can step in to help. Artificial intelligence, or AI, is changing the game for traders. In simple terms, AI is a type of computer program that can learn and make decisions. It is like having a super smart assistant that can analyze huge amounts of data very quickly. For a scalper, this is incredibly valuable. An AI can watch the market 24 hours a day without getting tired. It can spot trading opportunities that a human might miss. The main role of AI in trading is to process information faster and more accurately than any person ever could. This allows traders to make better, more informed decisions in a fraction of the time. AI helps scalpers by identifying potential trades. It uses complex algorithms to scan market data. These algorithms can be trained to recognize specific chart patterns or indicator signals that often lead to small price movements. For example, an AI could be programmed to look for a specific combination of moving averages and momentum indicators. When the AI sees this pattern, it can alert the trader or even execute the trade automatically. This frees the trader from having to stare at charts all day. The AI does the heavy lifting of finding the opportunities, allowing the trader to focus on managing the trades. There are several types of AI tools that scalpers use. One common example is a trade signal generator. This software uses AI to analyze the market and provide buy or sell signals. The trader then decides whether to act on these signals. Another tool is an automated trading bot, also known as an expert advisor. These bots can be programmed with a specific scalping strategy. They will then execute trades on the trader's behalf without any manual intervention. More advanced AI systems use machine learning, which means they can learn from past trades and improve their performance over time. Let's look at how an AI tool works in a real scenario. Imagine a scalper wants to trade on a 1-minute chart. An AI bot could be set up to monitor this chart. The bot is programmed to buy when the price crosses above a certain moving average and the relative strength index is below 30. It is also programmed to sell as soon as it makes a 5-pip profit or to cut the loss at 3 pips. The AI can execute this entire sequence, identifying the setup, placing the buy order, and setting the take profit and stop loss orders all within a fraction of a second. This speed and discipline are nearly impossible for a human to replicate consistently. The main benefit of using AI in scalping is its incredible speed. An AI can analyze data and execute trades in milliseconds. This is much faster than a human can even click a mouse. In a market where prices change constantly, this speed gives AI-powered traders a significant edge. They can get into and out of trades at the best possible prices, maximizing their small profits. Another major benefit is the removal of emotion from trading. AI does not feel fear or greed. It follows its programmed rules strictly, which leads to more disciplined and consistent trading. This helps to avoid costly emotional mistakes. AI also offers the ability to analyze vast amounts of information simultaneously. A human trader can only watch a few charts at a time. An AI, on the other hand, can monitor dozens or even hundreds of different assets and timeframes at once. This means it can find more trading opportunities than a human ever could. Furthermore, AI systems can engage in backtesting. This is the process of testing a trading strategy on historical data to see how it would have performed. AI can run thousands of these tests in a short amount of time, helping traders to refine and optimize their strategies before risking real money. However, using AI in scalping is not without its risks. The biggest thing to be careful about is over-optimization. This is when a strategy is tested so much on past data that it works perfectly in the simulation, but fails in the live market. Market conditions are always changing, and a strategy that worked yesterday might not work today. You must constantly monitor your AI's performance and be ready to adjust it. Another risk is technical failure. A bug in the software, a lost internet connection, or a problem with your broker's server can cause the AI to malfunction and potentially lose a lot of money. In summary, AI offers powerful tools for scalpers who want to gain an edge. It provides unmatched speed, removes emotion, and can find more opportunities. These benefits can lead to more consistent profits. But it is important to be cautious. Understand that AI is a tool, not a magic solution. You must be aware of the risks, such as over-optimization and technical issues. Always supervise your AI systems and never risk more than you can afford to lose. By combining the power of AI with smart human oversight, traders can navigate the fast-paced world of scalping more effectively and unlock new potential for quick profits.